All right, we good. How's everybody doing?
Terrible, man. Goddamn cruise lines. What's going on, man? It's just how it is
Yeah,
sometimes, right?
it's not really doing that good to be honest, cruise lines. But I mean, that's because RCL shit the bed. So
I mean, here's the thing. I don't think they shit the bed. It's whenever you have these kinds of markets, one of the things that you have to realize is that earnings are a time where it's all about expectations rather than reality, right?
mhm.
So what ends up happening is when expectations are really, really high, even the most minute thing could result in a sell-off. And that's exactly what we're seeing right now in the cruise lines a little bit, where especially with RCL was like a top darling. Their valuation was, getting to a high point. So I wouldn't say this is by the way, they beat on revenue, they've beat on everything. The only thing that they technically missed on was they lowered just one like teensy part of their guidance, which was like instead of having capacity like be like 8.1% growth in capacity, they're only going to do like 8% growth in capacity.
Yeah, yeah.
So everyone is like freaking out, like, oh my God, what the hell? So, what you're seeing right now is like an irrational sell-off, which is okay. I'm okay
Hmm.
with things like this because it gives you an opportunity to have a good entry point and a bigger discount. The one thing I will definitely fault myself for is that when I saw RSI starting to get a little bit too out of whack for the cruise lines, I didn't apply the strategy that we spoke about on the Patreon, which
Yeah, yeah.
to basically take some of the short leg and go down. Because I mean, it's fine. This is just how things are. We've got 2.5 years before we really have to worry about the damn thing. But and the fundamentals are looking stronger and stronger by the day. So it's not like we're in a bad industry by any means, or is it like going down? But I think the expectations got a little bit high. But I think this is good because this does set up Norwegian to have a much stronger
Yeah,
earning because the expectations have kind of been tempered down a little bit, right? And
yeah.
yeah, yeah.
I mean, they got the expectations are pretty high, and we already saw with a lot of the companies that reported so far. Like it really depends. Like Tesla, they rallied so hard into their earnings, so like they just had like one thing about it, which was I guess a lot of people priced in a lot of stuff with Tesla, so it just pulls back like 12%. But yeah, a lot of those setbacks can be somewhat temporary. But just to get started, wanted to introduce everyone to this new podcast that we're starting, Hidden Edge Podcast. It is something that Kris and I are just starting and mostly gearing it around the Patreon, but we are making this public in this particular episode. And in future
Mhm.
episodes, we'll kind of decide from there, whether we're actually going to make it public or not, or make it exclusive. But yeah, we're just kind of feeling the water, seeing how this goes. And with that, we could go into our first topic, which is macro outlook. And Kris, you did make a post on the Patreon very late last night, but if you wanted to just start talking about that, go ahead.
Yeah. So here's the deal. Right now, the Fed and the entire economy are kind of like teetering on: are we going to go into recession or are we going to have a soft landing? And what the Fed does going forward may end up helping us figure that out. Now, my expectations right now are a little bit more towards the recession side because I'm seeing a lot of data pointing towards a recession. And unfortunately, the solution that the Fed might apply, which is rate cuts, might actually make the recession come to us a little bit faster. And I know that sounds counterintuitive because it's like, oh, if you cut rates, shouldn't that technically like be supportive to the economy and supportive to the market? Which case now you can kind of, like spur up some demand on the consumer credit side, and boom, you've got yourself another bull market. Um, I don't know if that's necessarily the case. I see right now a giant freight train in housing starting to kind of come our way. And the thing is, because housing is such a big part of the general economy, if you start to see like prices weakening on the housing front, and then at the same time you start the rate cutting cycle, you're kind of setting up the economy for something really bad, which is all of a sudden now people are going to be anticipating the rate cuts and they're going to stop buying. And if they stop buying, that means that now prices are going to start to go up while at the same time interest rates are coming down. So what you're going to see is there's a period of lag that tends to happen. So imagine right now, just put yourself in the mind of a consumer, right? You want to buy a house, the Fed is cutting interest rates, right? What are you going to do? Are you going to say, yeah, I'm going to keep buying a house? Like, I don't care what the interest rates are. No, you're going to say, I'm going to wait until the Fed lowers the interest rates to the absolute bottom before I buy, because I don't want to just buy a house and then have to deal with the refinancing, right? Now, on the other hand, you have sellers who are putting houses on the market. So if you look at the inventory is growing more and more, and houses are sitting on the market for much longer than before. And at the same time, you're seeing the value of your home and your neighbor's home starting to go down. So you almost have like a reverse wealth effect starting to happen. And so I think it's really key to monitor the housing inventory. And based on that, you could make some decent assertions to say, okay, where are we headed? So I think right now we are at a point where the Fed definitely needs to cut interest rates, but at the same time, we're at a point where those interest rate cuts are going to have this lagging impact. And I think that lag is going to drive consumer sentiment down. And once it drives consumer sentiment down, spending follows. And when spending follows, now you've got underperformance on the earnings side for a lot of companies. And then you have like this self-fulfilling cycle of weakness throughout the economy. And so this is where you have to just, you have to figure out like, okay, what parts of the market do you want to be in during a period where expectations for growth get a lot more muted. And based on that, you just have to apply some good positioning.
Yeah. I mean, with that, what I brought on here was the yield curve, the 210. So basically the yield curve is it's a kind of a forward indicator for a lot of algorithms in the market and a lot of economists. Is that there's been this ongoing notion that when the yield curve inverts, that a recession is coming very soon. But clearly that has not been the case since it started inverting. When was this? June of 2022. And that means that we've really been, for about 2 years, the yield curve has been inverted. And what that really is trying to say is that the short-term rates, are trading at a higher rate than the long-term rates. And it's basically saying that people are not too optimistic about the future, about the near-term future. So therefore, they are buying more of the long-term duration and locking their money in with the higher rates. But what we've been seeing here, especially for about the last few weeks, is that the yield curve has went from about 50 basis points inverted to about it actually got as close as 15 basis points inverted. And it's actually pretty funny. They said in the Compound podcast yesterday, but I don't believe in triple tops. There's no such thing as a triple top. Double tops do exist. We do see it a lot, but triple tops are not. Triple tops don't exist. Triple tops is basically a breakout, usually starting to happen. And if we see over here in this chart, I got the tens minus the twos, and it basically made a triple top, pulled back a little bit today. And generally, when this goes upward, it usually means that it's usually non-correlated or negatively correlated with risk assets in the market. So this has actually been correlated with a lot of growth and mega cap stocks coming down recently, with a lot of rotation to value that we were talking about. We will talk about that later on in the podcast. But that's what I've been eyeing lately. And I noticed that once this thing uninverts and steepens even more, that's when you're going to see the newsreels come out, and they're going to be talking about this left and right. And by then, we're probably going to be maybe a few percentage points down. Probably. That doesn't mean we're actually going to be, but that's what I kind of suspect. Yeah, I mean, there's probably a lot more to that. I could go over the. Do you want to go over the? Oh, go ahead.
Yeah, I was going to say, usually you need a trigger,
Yeah.
right? If you look at all these recessions, there's usually some trigger that happens in the market that really like puts fear into the hearts of everyone, right? So the question this time around is, what is that going to be? What is it going to be around? So if you look at the recessions previously, you get the tech bubble bursting, then you had like which is the .com, and then you had in 2008 the issue with housing and subprime, right? this, and then you had technically COVID was also, because we did have a recession, even though it was so brief, like it was like literally months.
Yeah.
But that was technically a recession, so you had COVID. So all of these things kind of like add to the mix of things. I think it could be the bursting of an AI bubble, where I think the
Yeah.
expectations, especially among semiconductors, have gone so far up that the even a near chance or a miss on certain earnings could result in a huge sell-off like we're seeing with Nvidia today and over the last couple of weeks. So
Hmm.
I'd say we have to be very cautious and just make sure that we're positioning ourselves so that this way, we're not trying to play the hot potato game, right? Where just literally it's just passing hot potatoes from one person to another. And I think this is one of the reasons why I'm not bearish on semiconductors, but I'm definitely not going to be adding in semiconductors right now. If you look at the
Yeah.
earnings multiples, they are way out of whack. So, the chances of a correction coming in the semiconductor space is going to be relatively high. And I think that is probably the trigger that is going to send the market lower. So, and among them, I think mega cap 8, that's one of the reasons why the market is kind of like saying like, hey, maybe we don't need to be in so heavily involved in the mega cap 8. Maybe we need to kind of like broaden our investments out, right? So I think smart money maybe actually be moving out of big tech and into more value plays. And so this is where
Yeah.
you kind of have to like look at the rotation and say, okay, do you want to be part of the rotation or do you want to be against the rotation? So me, I'm more of the mind that, hey, I'd rather flow like the river with the market rather than trying to fight the market.
Uh-huh.
Usually people who fight the market, they have like some kind of crazy insider information on a specific company that can defeat the market's thesis. But most of the time the market does work in like a reverse fashion, where if expectations are high and valuations are high, in the short term you may look like an idiot, but in the long term you're going to be smart for avoiding that specific industry. And it's, believe it or not, it's really hard to avoid the hot stocks of the day.
Yeah, it is kind of hard. I mean, like what I see a lot of people doing is that they're trying to jump on what used to work, and they're not willing to jump on what actually is working right now. That is a lot of that's pretty much the inverse of what people do when they manage money. But on that case, a lot of the movement that you've been seeing coming out of mega caps, I don't think that's retail that's just doing that. I think that's a lot of smart money that's moving, a lot of big money that's moving. And I think that is fueling a bit of the rotation into value stocks. But yeah, when we talk about the rotate, we're definitely gonna have a lot more to talk about the rotation a little bit later on. But one thing I did want to point out is let's see here, the Fed rate cut probabilities. I did want to update some people on these. Hold on, let me just open up the window, share the screen. Here we go. All right, so I actually think this is pretty funny because we've been like oscillating back and forth. Like we started out the year 6 rate cuts projected, and then we started pricing in rate cuts, and now we're pricing in more rate cuts again. Originally, it was like people thinking that, okay, so we got the July Fed meeting coming up. There's a 93.3% chance that there will not be a rate cut. Rates are still going to stay between 525 and 550. All right, so that basically means no change. September meeting, there is an 89.6% chance that there will be a 25 basis points rate cut. And I mean, that's already in the market. It went down just by a tiny fraction in the last week. It was 94%, and then it went back down to about 90%. And then what I've noticed recently is that they are starting to price in a second rate cut in November. And then by December, they're pricing in a third rate cut. That's something new that I actually didn't think was going to happen. And because we talked about this before, is that like when you have a rate cut, that's supposed to be bullish, right? But the more that these rate cuts keep getting priced in, the market doesn't rip up with the mega caps. They certainly do rip up the small caps, but since that CPI data came out a couple of weeks ago, like IWM has just been skyrocketing higher and higher. Like, what do you think as far as the macro goes and the entire stock market goes when it comes to a rate cut? Do you think that is actually bullish for the stock market? You think it's bearish?
I for what's happening, I think it's smart because think of it this way: who are the rate cuts going to benefit the most? Is it the companies with the 35 and 50 PEs that are basically, still on like super growth mode, who have access to capital anyway? Like, you think Google needs anything? Whereas if you look at the regional banks, you look at some of the REITs, they've been absolutely torn up. They've been literally down to like single digit PEs for the most part. And a
Yeah.
lot of it is because of the impacts of higher rates on their businesses, their operating businesses. So I think what's happening right now is that the expectation of rate cuts are coming in, and people are saying, well, this company is super undervalued based on the current rate environment. But in the future, when rates do get cut, this company is actually going to do really well. So I want to be in that company. And so that's what I
Yeah.
think is fueling that rotation, And I think right now, this is just how expectations are. You always remember the market doesn't always move in like a linear direction up and to the right. It's
Yeah.
usually
Yeah.
like moves up and then down and up and down, up and down. So it's like a giant oscillator that goes up and down, up and down. And it moves in a certain direction, right? So if you look at how the stocks move, like you can sometimes even correlate it and just see a trend going in a certain direction, but the entire time you always have this oscillation. And that
Yeah.
oscillation is based on expectations, right? So if the expectation is 7 rate cuts, it's going to be oscillating higher. And then it's like, oh, we're only going to get 1 rate cut. It oscillates down. And then, oh, we're going to get 3 cuts and it oscillates back up again until you probably end up where the expectation is in between those two. And which is exactly what's happening right now, right? Like, so if we came into the year thinking that we were going to get 6, and then middle of the
It's a little
year, we
crazy.
believe that we're only going to get 1. Now we're projecting 3. So
Yeah.
technically, our original estimate should have been not 6, not 1, 3, and that's it. And just left it at 3. Keep that as your model, and just enjoy the calculation that way.
The market loves to speculate. Like, they just
Yeah,
love to
this is
speculate. Like, they love to speculate, and they're pricing into the futures. The funny thing is that Fed funds futures is really what determines these probabilities that the CME group calculates off of. And this isn't retail doing this. This is like smart money betting on Fed futures. And you could just see, like, even the smart money, they love to speculate as well. Like, they like, just because 6 rate cuts are priced in the beginning of the year, it doesn't mean that we are actually going to get 6 rate cuts. That's just the market front running what's actually going to happen. But more often than not, if the Fed comes into a meeting with a 90% probability of doing a rate cut, like, they're most likely going to do a rate cut. But there was a lot more information that was presented by that point that will, and data, which is what that they are reliant on, that will give them the fuel to actually do that. Someone asked a question here, or someone pointed out something. Seth asked, didn't this inversion break the trend of recessions occurring? So inversions is just a probability of a recession occurring. It doesn't mean that it's going to happen. So, it could still happen, and people will eventually say, like, hey, this inversion causes recession, and the recession won't happen for like 10 years. So, like, there is that. It doesn't mean it's not going to happen. It doesn't mean that it will happen soon. It just means that it will eventually happen. So, that to say that a lot of people, let's just say a lot of people came into 2023 bearish that a recession was going to happen very soon. And in fact, that's probably what triggered the entire market rally in the first place. The fact that everyone was caught off sides of that positioning. And then, of course, those earnings and the AI stuff. But yeah.
I think we would have got a recession in 2024, and even some parts of 23 had it not been for AI. I think the
Yeah, it had a lot
optimism
to do with
around
it.
yeah, the optimism around AI kind of came in and just supercharged everything. I mean, if you look at what Meta was trading at, Google, Amazon, all of them, they were absolutely decimated. I mean, at one point Meta was trading at an 8 PE. Like, I still remember
Yeah,
the
it's
day
pretty
when I
crazy.
saw that. And I was like, "Wait, what the hell is going on here?" But I mean, this is where the market really gives us a lot of great opportunities to be in it, right? But then you also have to remember that it's human nature to constantly just go after what's working and say, okay, you know what, I have the edge, I'm following the trend. And they rarely deviate from the trend. And I saw that happening, like, not too, like, pretty much recently, where we had people in the Patreon who have done absolutely well on some of the mega cap companies, because we were talking about, hey, the mega caps are undervalued, they're going higher. But then as the value of the mega caps got higher and higher, they were considering selling what was already there and saying, I want to take on more risk. I want to buy options even further out. What
Yeah.
do you call it? Even further out of the money. And I was asking myself, like, wait a second, no, we set a price target for 2026 for a specific reason. And the thing is, now that it's gotten to the point where the market is giving it a lot more value earlier than before, doesn't mean that we should change our thesis. Like, you have to be very careful with that. And I'm glad that I said that to that person, because that person could have said, you know what, I'm selling my near term stuff that's already working and taking that money and put it into further out with a higher strike. And right now, they would have absolutely got destroyed,
Yeah,
you know?
they would have probably lost a lot, like a good portion of their profit, just by
Yeah.
moving that over. And not to mention that when you actually roll a contract, you're unless you know you're extremely patient, you're putting your bid in there and you're just leaving it there. Like a lot of people, they just want to get it in there, and they're taking a much higher ask for their price, and then taking a much lower bid for their sell for the previous one. But yeah, man. I mean, best thing is just to be patient. Though they do it. They do a lot of our plays. They do expire in 2026, and we have a lot of time to wait for that one. Okay, so I wanted to get into the earning season. That is our next topic. Did you happen to listen or hear about anything with the banks as far as delinquencies and savings go?
Yeah, delinquencies are rising. I mean, the consumer is not as healthy as what was once put out there. So, with the rise in delinquency, especially in auto loans repossessions are like starting to get to like 2008 levels, close to it. So, this is where what's being projected out in the consumer side is starting to look a little bit worrying, right? Now, the thing is, you have to be this is a very weird occurrence that's happening, but you've got this bifurcation in the consumer where certain consumers, they are so healthy in the general market that they're able to go and splurge on things like cruises, go on high-end restaurants, go travel. But then there's also like a lot of consumers at the bottom who are absolutely struggling. And we saw this with what's this company? I just Lamb Weston. They provide they provide things to restaurants, and they actually just fell off a cliff because demand is collapsing. So a lot of restaurants are not seeing the amount of foot traffic that was out there before. So like the general market, like the general restaurants, their sales are weakening, which means consumers are probably weakening. But the higher end restaurants, if you go to like New York City, like me, Adam, Nick, who's Futbucker. I love his name, Futbucker, but at the same time, his real name is Nick. And we went to the sushi place, and dude, the entire place was packed. It was great. So I think this bifurcation in the haves and have-nots have started to absolutely go crazy. And so when I look at certain industries, I have to ask myself, like, okay, is this industry catering to like the general public, or is it catering to a more specific like niche market? And as long as that industry is taking care of that niche market, which is in a very healthy shape, I think they're going to be fine. Whereas the companies that are more broad based are going to end up taking a hit. So it's almost like, hey, this is the one time where you should be selling off McDonald's and buying Peter Luger's, which is rare that happens, because technically McDonald's is the one that you want to be in, because even though if it's lower margin, it also means that you have more broad scalability. So, you know,
Yeah, I mean that's a thing. Like when it comes to a lot of these restaurant businesses, is that I mean it really depends. Like you have a lot of upper class people and a lot of middle upper class people. They're just continuing to spend a lot of money. So the money really rolls into like these sit down and servicing restaurants, like Texas Roadhouse and stuff. But then you have like the I wouldn't say the lower income restaurants, but the cheaper restaurants, like McDonald's and fast food joints, like those are taking a hit mostly because it's like when you think about McDonald's, the amount of money that because I got two kids, and whenever I take the McDonald's, like that bill ends up being like $20, right? Probably like 5 years ago, going to McDonald's and taking the family out, I didn't have kids back then, but like you would only spend maybe like $5 or $10 to feed the kids and feed yourself, maybe $12. But to do that now, it's like like a Big Mac. I don't eat Big Macs, but I saw the price of that. It's like $8 or $9 for a Big Mac. So it's like, what's stopping me from eating here, eating at Chipotle or something?
Yeah. So here's the company that I was talking about real quickly right here. So, all right, can you share my screen?
Yeah, I'll share it.
Quick.
Are you able to share it?
Yeah. Just go down to the share thing and just.
Oh, okay.
There
Wait, how do I share your screen?
So there should be something at the bottom that's or like, do you see like the little participation ones like Kris and the other one on the?
Uh-huh.
There you go. You just.
Yeah.
Yep.
Oh, there we
So
go.
go ahead.
Okay.
There we go. Yep. So Lamb Weston right here is a holding company. They pretty much do like frozen French fries, waffles, and frozen potato products, whatever, right? So it seems like, oh my God, this is just some small company, whatever. But it's a bellwether. You know, this is one of those things that's going to show you, like, okay, what is actually happening here? And you can see that Lamb Weston, they literally have got halved in the last 6 months. So right now they're trading at a 7 PE. And the expectations that they had in their earnings was actually really low, saying, look, they're having absolute tragic issues. They're missing a lot. So this is where I'd say we have to be very careful. And so the state of the consumer is weakening. Yeah. Yeah.
That's a nasty drop. Actually, Texas Roadhouse, they report today after ours. So I'm pretty interested to see what's going to happen with Texas Roadhouse. I had a pretty big position in Texas Roadhouse near the lows. I got super lucky with, but I was DCing in, and I think I sold out maybe like around this level. But I've always just been checking on that thing. Just I don't know. Maybe it's the ego coming into check, but it's like, I got to make sure I'm right. Got to make sure I'm right. Got to make sure I'm right. And, it is turning out to be that way. But I mean, would you think about certain restaurants and certain industries where it's like, why is this thing priced at this expensive? Like it's a restaurant. Why is Texas Roadhouse this expensive right now? But I mean, people just bid the thing up, and then when it pulls back, some people they try to chase it, right? They have that recency bias where they think it's going to rally again, and sometimes it just doesn't, man. Sometimes it doesn't. So continuing with earnings season, I know you were keeping an eye on Google, weren't you?
Yeah. Yeah.
What are your thoughts about that?
I think Google is going to be fine, man. I think all these people, you're always going to have these, it's just a game of expectations. But I thought the bigger deal in the Google earnings was their spend on CapEx, which I thought Ruth Porat made a somewhat of a jarring prediction. Was just saying, what happened?
Was it jarring? I feel like you have a lot more you're trying to conceal yourself to say about it.
I think that they were a little bit like just saying, like, hey, listen, CapEx is high. Don't worry, we're going to control CapEx going forward. Which meant to me like, hey, they're going to be kind of like taking a bigger look at what they're spending on and their total ROI that they're actually getting from a lot of these investments that they're making, because, at some point with all this CapEx on AI hardware and infrastructure, you're going to need to make money, because if you don't make money, that's, defeats the purpose of being in business. So even right now, even though Google's top line is doing well, bottom line is doing well, you also have at the same time the bottom line being impacted by higher levels of CapEx. So I would say Google is a great place to be. I'd say Google is a great place to be, especially after this retracement. So
I mean, I was thinking about getting back into those spreads, because
do you want to zoom in a little bit so this way everyone can see?
Oh yeah, go ahead.
Yeah,
that's good.
There you go. Cool. Yeah.
Which one to look at?
Yeah. No, I'm just saying general sales and marketing. So you can see here that everything is pretty flat in terms of their spend. So their revenues have gone up. Cost of revenue has gone up slightly. Research and development they're almost at the same level. I mean, yeah, it's a little bit of growth. Sales and marketing, they're actually down, and general administrative, they're down for the last 6 months. I mean, this is the sign of a good CFO. Yeah,
Yeah.
this is a good sign that they're keeping things very, very, very much in check. And so that's why their earnings are about 3.82. Yeah. I mean, this is by 2026, this thing will be at the 225 target. I'm not worried about that at all.
Yeah, it has to be. I mean, especially like given the weakness of mega caps, like there really is like you're saying with CapEx, like they're really all buying a lot of hardware, a lot of infrastructure, semiconductors and chips, NVIDIA chips and all that stuff. Like it's not just NVIDIA that they're buying. Like if you build out a data center, like you're not just buying graphics cards. Like you're buying a lot more. You're buying memory, you're buying the server hardware, you're buying the real estate, you're buying all that stuff. And there really is a huge expansion when it comes to this. The only thing is that a lot of people are not seeing it being reflected in the revenues as far as AI spend. But I mean, I guess that's where the fear is, right? And that's probably part of the reason why it pulled back. I know YouTube revenues kind of took a hit a little bit, right?
Well, the thing is, their compute is going up, so the utilization for GCP is going up.
Yeah.
The problem is that a lot of the projects that are probably out there right now, they're very experimental, right? So a lot of companies are like, "Hey, we need generative AI." Like 12 months ago, if you didn't have AI in your earnings, like you took a hit. So what you started to see was this gradual like adoption of AI into the earnings calls where you remember when I think this was like literally 6 months ago, where everyone was talking about like how many times did the CEO say AI in the earnings call,
Yeah.
right?
They were like literally
And
counting it. That's all you'd see on
yeah,
like those spammers on Twitter.
right. And so now I think it's kind of like reversing a little bit because now the CEOs have kind of like waken up to the idea and says, look, we can't just spend money on a project that may not, pan out to bring a lot more value. And so I think AI is definitely a trend that's going to be here for the next 100 years, whatever. But the key is in the short term, the expectations might have gotten a little bit overblown, and I think a lot of companies are going to be dialing back on spending on AI related projects, which means that in the future you could also probably see some level of a headwind in cloud compute spending for a lot of the bigger guys, so Amazon, Microsoft, and Google, and that could negatively impact future growth. I mean, I'm not saying it's not going to grow. It just means that the growth expectations could be a little bit more blunted. Remember, everything is about expectations.
It
So
really is. Yeah.
if the expectations are high and you miss even slightly on it, that means that your stock is going to take a hit, just like the mega caps taking a hit right now.
Yeah, I mean, yeah, that's what we see. Like there was always that that overhead in the last earnings last quarter for Q1 was that they're going to jack up capex for the next year. I mean, even Meta said that, and that's why they pulled back so massively. But I mean, the same thing is the case even for Tesla. That's what Elon said. He's gonna be spending a lot of money, not only on buying Nvidia chips, but research and development to build up Dojo so he can start building their compute and being less reliant on Nvidia. That's kind of the model that I got. But I mean, besides that, ServiceNow earnings yesterday were pretty crazy. And when you think about where all of the AI spend is going toward for companies, like there was the infrastructure, and then now you're having companies like ServiceNow, which they are monetizing AI right now. Like they have AI features, they have ServiceNow Assist, and a lot of companies are really buying these products from ServiceNow, expanding their top line. And one thing that I did get from the earnings yesterday for ServiceNow was that Bill McDermott, who's that dude, he can really talk, like he can really sell a product. He was talking about how the total contractual value. So one of the analysts did ask a question like, how did your RPO increase so much this year? Was there a lot of like pull forward from future quarters? Did a lot of clients like sign up a lot earlier than they expected to? And what they're basically saying was that clients didn't pull forward their signups. What they did was they ended up extending their contracts so they can get a cheaper price or lock in a cheaper price. And what that's kind of saying is that like some companies are willing to spend in certain places depending on where the value is coming from. I mean, if you think about a lot of these crappy AI companies, selling crappy products. When you think about ServiceNow, yes, they are monetizing off AI, but overall their entire product is a really good product. And these CIOs are just spending money toward that stuff. And I think that's totally reflected in the stock price today. I mean, it's already in think it's like in the 850s right now. Let's see here.
I'm not sure.
It's at 843. I mean, that's crazy. It's actually at an all-time high right now.
Yeah.
Let's see here. I'm still getting used to
StreamYard.
Yeah, I'm still getting used to it,
It'll
man.
take a minute. Then you'll become like Amit, just waking up in the morning and doing
2 hour
this, doing
streams.
that. 2 hours stream.
2 hour streams, man. That's
Dude, that guy's got energy, man. He can he can stream all day, talk all day. After about 20 minutes, 30 minutes, I start getting like, oh,
yeah, no, that's a I don't know how his camera doesn't die, but
it does die. That's why he's got 2 of them.
oh, he's got 2 of them. I didn't realize he actually switches during it. Look at this freaking chart, dude. Look at Surface now. Like, this is crazy. Damn, man. I mean, my portfolio is very, very much weighted toward software, so this is pretty good to see. Yeah. So we got our next thing we're going to talk about, market rotation. I think this is the sweet one we want to discuss.
So, since you have this up already, so do this. Go to the search up there and go to IWM.
Over.
And then put I think the other one is what is the general
RSP?
No, RSP is equal weighted. Do SPY.
SPY?
Yeah. And
yeah, look at this breakout, dude.
And put on the left hand side, just put percentages. So no. So you see where the all the way onto the right side of the thing, just left click there and just right there. Yeah, click left and just put percentage. There you go. So you're seeing this giant candle, and you're seeing this giant candle going higher this way. So look at that rotation that's happening between IWM and SPY, where literally SPY has outperformed IWM like crazy, and now you're starting to get that rotation in the other direction. So this is believe it or not, this is why Tom Lee is saying that there's still a lot more room for the IWM to catch up much higher going into the second half of this year, because eventually this is going to retrace back to its normal mean again. And I think he's right. I think this is where you would have to just position yourself to be a little bit underweight on some of the mega cap names, and instead be more focused on some of the more, I would say the catch up names that are out there. And I think the easiest way to play that, believe it or not, is actually just shifting into RSP instead of being in SPY. So do you know the difference between RSP and SPY?
Yeah, RSP is the equal weighted. So SPY is market cap weighted. I'll be right back in like 30 seconds. I got to grab a charger.
Yeah, no worries. So when it comes down to RSP versus SPY, SPY is a market weighted ETF where it still covers the S&P 500, but the S&P 500 is divided up based on the market caps of the company. So right now, if you look at like the total representation of the mega cap companies in the S&P 500, it's super, super heavily weighted towards that. And the rest are kind of just like, existing. What we're likely to see is the rest of these guys are going to catch up, and the S&P and the guys at the top are going to either go down slightly, or they're going to perform normally. So as this rotation happens, where do you want to be? And in my opinion, the best place to be if you want to be in an index is be in RSP instead of SPY. And I know like not a lot of people talk about RSP, but RSP tends to actually perform very similar to SPY in a healthy market. But this is of course has been a very different market, and so we don't have necessarily the same fundamentals. So I think among the large caps, there's a lot of opportunities looking outside of the mega cap 8 to add to positions, and then also with regards to Russell, there's actually some opportunities among small caps as well. But I think with the Russell, you have to be a lot more judicious where you allocate towards. So For me right now, I think the two areas that I'm heavily focusing on is one, I'm all focusing on regional banks, which have been doing well. And so I have positions in KRE. And as you guys will see in Cash Flow Chronicles later this week, we actually took a position in DPST, which is a triple leveraged ETF that covers regional banks. And another area that I'm also bullish on is, of course, the rotation to REITs, specifically office REITs. I think office REITs are still undervalued. I'm starting to see the return to office starting to gain momentum. I have a few friends of mine. One of them works for Truist, and they pretty much called him back saying, no, you have to come back 5 days a week to the office. The other parts of their team, they're telling them to come back like 5 days, but it's going to be at the end of the year. And so I think there is a push to get more workers back to the office. And with a weakening labor market, I think the chances of employees kind of pushing back on their employers is starting to kind of like diminish. So employers are really, really pushing for a return to office to happen. So that's going to be one thing. And then at the same time, you're going to have a lot of these REITs, what everyone was worried about, what are they going to do about, refinancing some of the debt that they have? Well, if interest rates get cut, that's going to benefit them because they're going to be able to refinance at more favorable rates. So I think right now I am more heavily weighted towards regional banks, towards office REITs. Yeah. There you
Let me
go.
check this out because I haven't even like looked at KRE in a while. Well, not in a while. I've been keeping an eye on it, but I haven't really
Yeah.
been checking it. Oh
Look
yeah,
at KRE. Look at
it's like
KRE
ready
and
for.
yeah.
It's like prime
Look at
for.
look at for KRE instead of DPST. The
Yeah,
problem is when you look at these triple leverage companies, right? Triple leverage always looks really freaking weird.
yeah.
But
There's
look at
decay on
this.
it.
Yeah, look at
It's a
this.
carry
And
trade.
if
Yeah, this is
yeah,
crazy, dude.
and if you look at the PE on all these regionals, it's actually really they're trading at pretty like favorable levels. So I think with the expectation that maybe the office sector is not going to get absolutely decimated, some of the regionals are coming back. With with regards to AOCI losses being able to be controlled, they're going to do well. So like look at some of our favorite regional names. Look at TFC. That one is a Kris Patel special.
TFC is crazy, dude. Like I
This,
remember when this thing was at 28 before. I still remember when it was at 28 and no one wanted to buy it. I think you double dipped in this thing too, right? Like you got in like around here and
yeah,
then you got here and you took some profit in your spreads and
yep,
you got back in over here. Like this was the spot right here to get back
yep,
in. And I
yep,
let go of it like right here.
yeah. No, there you go. Truist is going to do a lot
Yeah.
of regional banks are going to do well. Look at regions up there. Regions. I don't know if you have that in your list. Or US Bank
Uh,
is another regional. Regions Bank.
oh, the Regions Bank. Also
Yeah,
there's
there, there it is. Regions Financial Corporation (RF).
okay.
See,
Damn.
they're breaking out
That thing
too.
is oh, I was gonna say it's near all-time highs, and then I zoomed back over here. I'm just like, oh,
Yeah, yeah, I
never
know.
mind, another another night.
Yeah,
But yeah, dude, like I know they're definitely gonna come back. I mean, it's really in their favor.
yeah,
Especially when you think about a lot of people, they're gonna start taking on more loans. They're gonna start taking on more credit. Maybe putting more money in the bank, which gives these banks a lot more leverage to actually start loaning out more money at a better rate as well. But yeah, I think a lot of these banks they're really locking in like those high interest long term
Well, it's
appreciation.
more so because remember their loan portfolios got absolutely decimated after SVB collapse, right? So SVB kind of like really brought the regional banking sector to its heels because when they came out and said, "Look, we have all of these loans that are outstanding that we lent out at really cheap rates," that meant that they have now something called AOCI losses on their balance sheet. And because of those AOCI losses, there's chances of them actually, basically getting hit by a bank run and knocking out their entire business. Clearly, that didn't happen with all these other regionals. And so a lot of great regional banks like TFC got caught up in the same kind of like conversation. Now that we're seeing, that, hey, regional banks are going to be okay. I think a lot of people are rotating to them. They're great businesses, and now with the regulatory hurdles kind of being a little bit more easier to navigate. I think this was a great play, man. I was
Yeah, I mean,
surprised when people didn't
it,
realize it.
it
Yeah.
double dipped at the bottom over here. I mean, like it came back here to 30s. And I still remember when it was in its 30s, like no one wanted to touch this thing. And then it came
Hmm.
back again in late 2023. But
Yeah.
and they gave us another opportunity here. Like this is really just a clear uptrend right here. And some people they even look at this and just like, oh, well, it kind of filled like whatever small gap might be up here or something. So like that's pretty much it. It's like, no, these things have a lot more room to recover. And it's really the same thing when you think about cruises. I
Yeah.
mean, it's just look how much room you have. It might not come all the way back up here soon, but just
Yeah.
look at all this room. Like this Carnival has not even recovered. Most cruise lines, NCLH and Carnival, they haven't recovered since COVID, right? But if you take like
Well,
RCL, oh, go ahead.
yeah. No, well, you have to be very selective with the
Yeah,
cruise lines because a lot of them, well, not a lot. Let me just rephrase that. Norwegian and Carnival issued a ton of shares. So there, if you look at if you look at the same chart and you weight against like market cap, right? You can see that from a market cap's perspective, they're not that far away from being, um, you know, overvalued. Because what happened is because of a lot of those share
you're talking about
issuances,
Carnival, right?
Carnival
Yeah, yeah,
and Norwegian, so they diluted a lot of shareholders. So it's a lot of people look at the chart and say, "Oh, well, you know what? This looks like it's undervalued by a significant amount." But I'd say that no, they're undervalued, but maybe not undervalued to the same degree that a lot of people are thinking they are. But here's the thing: when that businesses does improve, you're going to be in a much better shape. Like so, Royal Caribbean. If you look at their business, Royal Caribbean has done extremely well in the last couple of years. But one of the reasons why is because they were much better stewards of their capital at the time when COVID was happening, and they didn't issue a lot of shares and they didn't issue a lot of debt. Royal Caribbean, I mean, Carnival and Norwegian did. So they are kind of going to be, in my opinion, they're going to be laggards for a while. But remember, with the options that we have, they're about 2.5 years away, right? And so
yeah.
it makes more sense to be in those names as you're starting to see like revenues recover and everything. So it gives these companies a lot more optionality to do more things. To one, do share buybacks, of course, but then also reduce down their leverage. So I for one have a thesis on why RCL and CLH are going to do well. I mean not RCL, CCL.
Yeah.
So I think that they're more correlated than RCL. So we'll see what happens with earnings. But I think if Norwegian does really really well during earnings, Carnival is going to be the sympathy play, and they're going to grow at the same time. So
Yeah, I mean, like look at these metrics, right? Like, so if you look at just the growth alone, out of all of them, RCL is growing the fastest. I don't think this is actually comparing from the earnings this morning, but in comparison, Carnival is growing very close to the same rate as RCL. And I think I was telling you this before, their margins, when it comes to gross profit margin, like Carnival Cruises has 51% gross margin, RCL is 47%. And if you look at the net income margin, RCL already has 14%, Carnival has 3.85%. So if you think about the decreasing the amount of cost to meet that gross margin, there's like a lot of wiggle room for
yeah.
Carnival than there is for RCL, especially
It's
like,
mostly
look at
it's
this
mostly
differential
because of
right here.
interest rates. It's mostly because of
Yeah.
interest rates.
Yeah.
Like interest rates, when they start coming down, dude, CCL and Norwegian are gonna just love it. If you look at
Yeah.
how much, you look at the interest expenses for both of those companies, if it's listed in there, their interest rate
Um,
expenses have gone up, and that's what's impacting their earnings. You know,
long term. No, it just lists
let
the
me share.
ratios for it.
Let me share mine. 1 second. Let me see.
Yeah, go ahead.
See, this is the one thing you should see: different people using different softwares to get an idea of what they're analyzing. You know, like you like Seeking Alpha. I hate Seeking Alpha. I think there's
I
just
like Seeking
so much.
Alpha, FinChat. Yeah.
There's too much. There's just too much. In my opinion, there's just too much noise on Seeking Alpha for me to. Hold on. finish. Let me just share my screen. Okay. Share screen. Okay. Can you guys see? Actually, no, not this one.
Yeah.
Let me just share
Oh,
the other one. Share. I got the wrong
I'll
one.
throw it up once you share it.
Window. Okay, there we go. Can you see that?
Here you go.
Okay. So you're looking at Carnival, right? So you can see here like a 5-year period. It got absolutely decimated downward. Now the thing is, because of this, now you have the stock trading in this pretty much this weakened range. The reason why is because if you look at on a TTM basis, their net income, right? Their operating incomes are starting to recover back to like normal levels again. The problem is this interest rate expense. Look at this interest rate expense that
Oh, that's what you wanted to see. Okay.
yeah. So you can see here the interest rate expenses for Carnival went from literally 200 million a year to right now almost 1.9 billion. How crazy is that?
Yeah, that's gonna hit their bottom line pretty hard.
So now the question is why would you want to be in this if this is what's happening? And the reason why is because the company is actually generating a ton of cash flow,
Yeah.
and they're actually guiding for less capex going forward. So from an operating cash flow standpoint, they're generating almost 6.5 billion in cash flow right now, in operating cash flow, which means that now they have the optionality to kind of pay down a lot of that debt. And what's good is that Carnival has a lot of strategic debt that they can pay down to basically like reduce down their interest rate expenses significantly, and a lot of that interest rate expense is going to end up reflecting in the next few quarters. So you can already see that happening right now, where they went from 2 billion to right now to like 1.9 billion. So if you give it about 12 quarters, and you can see this giant reduction on both the interest rate, from interest rates getting cut lower. So a lot of their floating rate debt will start going down, but then also as they pay down debt, that number will go down. And as that
Yeah.
goes down, it'll all come right back into net income again. And when it comes back into net income, you can safely do a calculation and get an idea of where this thing is going to be. And it's the same thing with NCLH, right? NCLH right now, if you look at their revenues are actually at all-time highs, right? Operating income is not all the way there yet, but it's starting to
There's a lot
recover
of room.
nicely
Yeah.
also. But if you look at the interest rate expenses, they were like, they had to do share issuances here, but they're still much, much higher than they were pre-COVID. So
Yeah.
the real thing with Norwegian and Carnival is that they have to improve their balance sheets and delever, which, believe it or not, because of the strong demand, it's happening. So if you look at it on a cash flow perspective, look at the operating cash flow for Norwegian. It's back to normal again, to pre-COVID levels, actually exceeding pre-COVID levels. So the estimates that they have going forward, in terms of operating income, I think that they're going to generate about my model is telling me that they're going to generate about 3 trillion. 3 billion in EBITDA by 2026. So if they're generating about 3, maybe 3.2 in EBITDA, you usually they trade at about a 9 multiple on their EBITDA. So you multiply that by 9, and then you just subtract out the debt, which, by the way, is probably going to be flat and maybe a little bit less. You get yourself almost like a double on where it's trading right now. So 36 is not hard to get to for Norwegian.
Well, I mean, it's not only that, but a lot of people just are not positioned correctly on the cruises, right? It looks like dead money for the last 4 years for a lot of people. So they're just not really into it. And plus, with all the debt and everything, like you're even saying before, that a lot of smart money in hedge funds, like they cannot invest in this company given the amount of debt they have. Like it's just one of the stipulations of their rules on what they can actually invest on with their clients' money. And then once this thing starts to increase their cash flow, lower their debt levels, lower their interest rate expenses, and then you look at a chart, that's when the chasing will start happening.
One other thing to note is that if you look at Norwegian right now, their earnings expectations, the closer one's about 1.46 in earnings. it's going to be about 2.5 in earnings. You know, the cruise lines, they typically get about between 12 and maybe, well, sometimes at a high point, they'll get like an 18. So I cut it right in the middle, and it's like around 14 PE is a good amount to pay. So if you look at them on a forward basis
Yeah,
for
they're
like
not even.
2026, look at
Mhm.
this. They're going to be generated, you know, if they even come remotely close to this EPS, which by the way, I think this is a very predictable business. I think they get to 2.5, maybe even 2.75. You're looking at a 7.5 PE. You double this up, it gets you to that 14, that magic golden number that you need, which means that literally this thing easily can double from here. You know, it's not
Yeah,
rocket science to figure out like, okay, where's this company going to be by the end of 2026? Now, of course, the market can, you know, move sideways, up and down, left and right, but I think eventually you could it's going to get there. And even right now, based on like the guidance that they gave for 2026, it looks like they're pretty much going to be hitting those numbers. And on top of it, if you look at the earnings per share growth, you're looking at about 30% EPS growth for the next couple of years, and then it going to like 20. So this is definitely a company that, in my opinion, you could buy right now, hold it, and you'll actually outperform the market, right?
yeah. I
Especially
mean,
on a 4P basis. Yeah.
those are just consensus estimates, so they're gonna beat those by a
Yeah.
lot, and that's
Yep.
really is gonna drive the price up. The next topic I wanted to talk about, I mean, we could do this one pretty quickly, is cybersecurity. I know you had to deal with just the minor incident that happened last Friday, just the minor incident. But what I wanted to talk about was just the amount of bullishness on CrowdStrike. And in my opinion, a lot of it is a recency bias, right? Like you have a company that's, well, it is one of the best of breed when it comes to cybersecurity, especially endpoint. And then they have like over 50% of the market share when it comes to endpoint. And people are just like buying it hard, hand over fist. They think that all this publicity that they're getting is good publicity and it's good app free, basically free advertising. But if you like really think about it, a lot of people didn't know what CrowdStrike was before last week. Like a lot of people didn't, and now they do. But it's not in a good light. It's in a bad light. And then especially the other day, what was it, yesterday? They issued a $10 Uber Eats gift card to all of the, I think all of the back end staff that had to deal with the issue. And it's like, dude, $10 on Uber Eats like doesn't even pay for the fees. Like, what are you gonna do with $10? Ahmed was
Dude,
not.
I spent
Ahmed was,
50,
yeah,
I spent $20 getting from my hotel to my hospital that day
yeah. Like,
just so I could deal with this bullshit. So
what was it? Some people were like saying that a shake is like $20 on Uber Eats. Like, well, you can't even get Chipotle for not even $15 on Uber Eats. You know, like even if you go to the restaurant, you don't do Uber Eats and you just do pickup, like you're still spending like $15. So it's like, how does this help you? You know, if you think about how much they had to put out to do that, or whatever deal they had to put out to be able to release that, maybe they had some deal with Uber or whatever. I just like the beginning of the compensation and reparations people are going to get for this mishap. Like I actually think that this might trickle down to more issues in the future than it will today. Because then there's also those people who are those scam artists who are trying to like present themselves as official CrowdStrike assistants and like reaching out to companies, whatever, saying like, "Hey, we can help you," and it's just send us like your Bitcoin, we'll help you do this. And it's just, I don't know, man. Like I held a lot of CrowdStrike before it. I got rid of a lot of it the other week, and it's just I'm not
you
trying to
got
buy this
lucky,
tip
bro.
card.
You
Yeah, I
got
got super
lucky.
lucky, dude. But I mean, the valuation was getting pretty crazy. It was like it was more expensive
Yeah.
than Palantir. And I mean,
Mhm.
I don't want to get started in Palantir, but it was more expensive than Palantir. It was trading like 21 times EV/NTM. Given that their rule of 40, I think they're like rule of 60 or something. So they're pretty good. They're growing at a very good clip. They had high margins. They're gap profitable, but like after an incident like this, like they might go back to unprofitable territory. And if that happens, we're going to see this thing in the hundreds again.
Well, I think what it's doing is making a lot of companies question a couple of things. Number one is redundancy. They're saying, okay, you know what? Maybe we need like a redundant system instead of trying to be overly reliant on one. And the other thing is that, dude, my organization, they took cybersecurity so seriously that they screwed themselves with this because not only were all these PCs that we have um all all like blue screened of death, but then they were all BIOS locked as well. So no one could get into safe mode without
Yeah.
like doing
Yeah.
all sorts of crazy things. And what's messed up is half the users that we have are remote, and those remote
Yeah.
readers, there's no way to get in for them.
You
Like
have to
you
go into
can't.
the office. You got to bring it to IT. They have to log into your
Mhm.
computer. They have to put in the password for the BIOS, and they have to go in there, put it in safe mode, and delete whatever file. And most
Yep.
users are using Windows, right? Like especially when it comes to
Yeah.
hospital, like they're probably using like Windows XP or Windows 7 still, like some old ass
Yeah.
version of Windows. And it's like, what are they going to do? You're gonna walk a doctor through
No, dude.
unlocking BIOS, going to
Dude.
safe mode. It's like, dude, that's not going to work. All right. Because a lot of these doctors, a lot older, they're not technology proficient. Yeah. They can like, they can cure someone from like whatever disease, but like they don't, a lot of them don't really know how to run a machine.
I would say
It's just,
one thing.
yeah.
All the doctors, if you work in any field and you're not an IT person, learn your damn IT people's names, for God's sake. Dude,
Yeah.
I can't tell you how many people came to me that day and they're like, "Hey, you're the IT guy, right?" And I'm like, "Dude, my name is Kris. I'm a person,
Hey,
like
you're the
it's
SLG
like,
guy, right?
it's like, how long have you been here?" I was like, "I've been here for 5 years. I'm the
Yeah.
one
Yeah.
that did your in-service. You remember?"
Yeah.
"Oh, you're that guy." Like,
Yeah.
yeah, that guy. Like the
They
guy
don't
that
like you.
basically,
Yeah.
bro, IT is like being part of IT is like being part of the scum,
I, I
It's
know.
like it sucks,
They,
dude.
they,
But then
they only reach out to you when they need you. That's what
yeah,
usually happens
yeah,
in your IT when they need you and they need it now. Like they don't need it
yep,
next week; they need it now.
yeah.
Well,
Did
but
you see like
go ahead.
did you see the meme of what do you call it, with the IT people walking in from Silicon Valley, walking in when let me just see if I can find it. It was actually an amazing meme. Hold on one second. My wife sent it to
Yeah,
me. Yeah.
the
But
funny
I
thing.
said
Oh,
that
go
we were
ahead.
like the Night's Watch. The Night's Watch is exactly where we were.
Oh, are you like the Jon Snow of all of them? Are you leading everyone into victory?
No, no, not at all, bro. I'm like, I'm fucking Hodor, bro. That's what I
Yeah.
was that night because I was on call that night covering everything.
Hold the
So
fucking door.
I was Hodor, bro. Hold the door. And everyone's
Yeah,
like, "What the fuck is going on? How come I can't log in? Hold the door."
yeah, dude. Honestly, it's I'm pretty glad I'm not in help desk anymore. But if I still was, like, I'd have to be dealing with some disasters, just like dealing with people who like, and a lot of these doctors and people who aren't really tech savvy, like they don't really use a computer. Like they don't use their computer. They just have an assistant to do everything for them. And the fact that they have to go into the computer and take it, oh man, there's probably still a lot of stuff that's broken down.
So for
Uh,
us, like I didn't have to deal with the doctors themselves, like because I'm not desktop support. I manage certain applications in their backend, but I don't deal with the day-to-day stuff. But dude, I'm like because I'm associated with these applications, they automatically call me. I
of
mean, I
course,
had fun just
you're
rerouting everything
IT.
to desktop support. I was like, I was giving them the wig, the runaround. I was like, no, I'm not that guy. Like, you
Yeah.
got to go to that guy right there. So,
You're IT, man. Of course. Like you do everything. You know how to fix a
yep.
computer. The problem is that you probably know how to do it, but you just don't have the permissions or the administrator rights to actually do it. So you can't do anything.
I do have the right, but I
Yeah.
won't fucking tell them that.
Yeah,
Nope.
no, you,
No,
you
no,
don't
no,
you don't
no.
want to tell them that because then they're gonna come to you from now on. You're
You
gonna
know
be
what?
their triage support guy.
There's this one doctor that I'm not a big fan of. Okay, and I'm very official with that doctor because he complained one time that I wasn't helping him enough. So I said, okay, all right. Hey, doc, did you put in the ticket? Did you put in a ticket? And they're like, I can't get into my computer. How am I supposed to put in a ticket?
Yeah.
Oh, you just call this number right here. Motherfucker was stuck an hour and a half on the fucking call just
Yeah,
to
but
get through.
did he hang up that call and call you back or just like I can't get this to work? It's just,
Nope.
yeah,
No,
that's
no.
good then.
Hey,
That's good.
listen.
That's good.
See, the thing is, if you were nicer to your IT guy and you knew my name and you actually like, worked with me, I'd be like, okay, yeah, let me see what I can do for you to help you out, but
Yeah, yeah.
if you want to play that game, also,
Nope.
I'll slow walk them too. Did you
Yeah.
try restarting your computer? You know?
They always say that the best way to deal with someone, the best way to deal with an angry customer is to be extra nice to them because that'll just piss them off even more. Like if you have like I used to work at Target in the cashier section. Sometimes we get like these nasty people coming in, and it's like when you're so courteous and nice to them, like it just makes them even more mad. Like it's like, oh, I'm sorry. How about you do this? Like you troubleshoot them through something that's like so mundane and so easy, but then it just pisses them off because it makes them feel like they don't know what to do, you know. But
Gail's IT. You know how you know Gail is IT? Plug it in and plug it to take
there
it
you
off.
go.
That's
There
another
you
one.
go.
That's another one. Dude, I still remember telling this one time. Did you try reseating the mouse? Did you take the plug out
Yeah.
of the mouse? I knew
Sometimes
that
that's the
shit wasn't
answer
gonna do.
though.
It
But
is sometimes it is the answer.
sometimes that's the answer. You know, it's like, did you try
Yeah.
restarting a computer? Oh no, I didn't. It's like, well, that 99% of the time, that's going to fix your issue.
Yep. Yep. Yeah.
All right. So wanted to just run through this next segment called new prospects. So basically for this one, we're just going to talk about like what's kind of on our radar and our watch list that we were kind of doing some DD in the back end for. For me, and I'm not copying this from Joseph Carlson, but I have been looking at BKNG for a while, booking.com. And we've talked about this in the past. It is literally a tech company for travel, right? Like you have it used to be Priceline. They acquired Booking, or I think Booking acquired them. Now that I think about it, I forget which one. But dude, they're when you really compare all of these companies, like, you know, for travel, hotels, and everything. I know you're really bullish Airbnb. Like when you think of Booking.com, like they're already a leader in the game, and they're kind of like Warren Buffett, where like right now their stock price is. Hold on, let me just actually pull this up.
I'm not gonna lie, I'm a little bit worried about Airbnb doing some DD that I have.
Oh yeah,
There's been some suggestions with a lot of users. Basically, what they're doing is, you know, I mean, because I mean, it's all about the listings, right? So a lot of these companies that like list on Airbnb, they do it out of sheer convenience. And
yeah.
so one of the trends that I'm seeing is that, you know, number one, a lot of these companies, they don't want to pay Airbnb all these fees just to basically list their stuff on
So they
Airbnb.
circumvent them, so they don't have to pay for those fees. Like they go through a
Right,
different. And some of them, they
right.
actually, there's a lot of like Marriott, for example, right? Like they're starting to decrease their prices where they're actually competitive with local rentals or local vacation rentals, where it actually makes sense
Mhm.
for a lot of these for a lot of travelers and people to book directly with the hotel instead of booking like an Airbnb or something. For me personally, I've never stayed in Airbnb before. But you know, I guess the moat for the company and what's really good for them is that their cash flow is actually pretty good and they have a huge balance sheet. But when you look at booking.com, it's always traded at a premium, right? And
Mhm.
I think Joseph Carlson was buying it like in the high 4,000, but like that dude doesn't care, like, you know, where it is, where the actual short-term price action is, but it's actually pulling back considerably. And I've kind of been more inclined to do a bit more research on this, mostly because of the rotation that's heading toward value stocks more. But
Mm.
this is kind of, I feel like travel is kind of bottoming out. I mean, yeah, if we do get hit with recession, with the consumer gets hit, you know, we're going to see a little bit of a pullback in traveling. But if you think about a company like this and you start DCing into the position, then you might be able to build a pretty good long-term position at a pretty good price, you know, depending on where price goes short-term from here. Like I could see it visiting the low 3,000s or even coming down here to 3420 area where support is. It's going to kind of base out here. But, you know, of course, if there's a recession, this thing's going to get hit, you know, and I don't know. I just think long-term, this might be something good to get into. The numbers are really good. The old CFO was actually, he was actually a guest on the BG2 podcast in one of the
Mhm.
earlier episodes. But like their model and how they go through, it's a very well ran business, in my opinion. I mean,
Yeah.
booking.com is like one of the most used travel sites out of all of them for the most part.
I think Gail got it right. Gail said exactly right. Just use the reverse image search. You just basically screenshot the image of the listing because they use the same listing photos where you go. And once you do that, you can find where the listing agent has actually listed the thing. And so this way you can actually get a pretty good discount that doesn't have all these
That's
additional
actually not a bad
Airbnb fees.
idea. Yeah.
Yeah. Yeah.
Google's pretty good with the image search, man. I'm not going to lie.
But the only challenge is not all the Airbnbs are like part of these secondary larger, like, what are they called, host companies. A lot of them are just literally mom and pop, like, you know, I just want to rent out my cabin for the weekend kind of thing, you know.
Yeah.
And it is still the largest platform out there. So like I said, there's still value there for Airbnb. I'm not saying there isn't. It's just a matter of, you know, like could their business model be somewhat disruptive? I think so. It's kind of like Uber, right? Where Uber is still standing strong, Lyft has gotten decimated. I think the taxi cab industry is kind of limited because the thing is, like, there is a consistent product to call all regions. So if I'm an Uber, and that's my bull case for Airbnb, by the way, which is I have a track record now with Airbnb because I'm a good steward when I managed, you know, when I you know, rent a property for the or a short for a short term. So now I have this inbuilt kind of like reputation, which means that I can get a booking easier versus someone else who may not necessarily be the case. And it's the same thing where if I see someone with 5 stars in their listing, that gives me a little bit of a confidence that it's a good host, right? So you're not stuck with a, you know, a shitty host. Because I mean, remember, the quality of a host is going to differ materially from place to place, and the last
Yeah.
thing you want to do is rely on, you know, like chancing it with a host that you may or may not know. So
Yeah, yeah. The ratings. I mean, it really depends. I know Booking.com. They pull in ratings from different websites. I'm not sure though if it's like partner websites they only pull it in from, but I'm sure if like that might take out the moat a little bit there. Like, let's say Booking.com starts pulling in ratings from Airbnb. What would actually prevent someone from posting their rental on Booking.com versus Airbnb, or maybe do both? Right? Like, I don't know what the cost is to actually post a listing on Airbnb, but what if someone posted on Booking.com and Airbnb, and then Booking.com charges them less? Definitely has way more viewers and people looking their website. It's going to kind of steal the clients from them. You know, they're going to take more
yeah,
market share, and I think that's already happening. But you know, I definitely think the hotel and the servicing and accommodation industry is definitely going to come back.
yeah, yeah.
All right. And the last thing we wanted to talk about was Patreon updates. I just wanted to kind of give a little bit of an update as far as Discord goes with the Patreon. If you haven't, you know, if you're curious to see how it is, see some plays in action, or get some of the benefits that a lot of users, because we are doing this weekly update here on YouTube live as part of the podcast. So if you are interested, there is actually a link below in the description to join the Patreon if you want to check it out. And you can always reach out to Kris, send a message if you have any questions before you actually register for it. But the Discord is going to go through a little bit of a makeover. There's a feature in there to enable communities, which is actually going to give us a lot of features that are not currently available in our existing infrastructure for Discord. And there's going to be different layouts we can have for different channels. We're definitely going to consolidate a lot of channels. And the channels that will be consolidated will still be available as read only in the archives, but they will not be deleted for some time. You'll still be able to access it if you need to. And really, it's going to be a little makeover to make the user experience a little more pleasant, and it's going to reduce the amount of possible spams that come in. I mean, you know, what Discord nowadays is not getting a lot of bots that come in and start spamming messages asking for Bitcoin and stuff. So yeah, I mean, you know, there's going to be version 2.0 coming up, and probably going to do that this week. So get ready to get the rollout with that one. Anything else you want to add, Kris?
No, no, I think we've done well in this market so far. I mean, not for the last couple of days with the cruise
Yeah,
lines taking a
the
hit.
last couple of days was not great, but whatever.
Yeah, but whatever. That's just how the market is sometimes. But overall, we're in a healthy place. There is a rotation happening, and just we want to be a little bit of ahead of that rotation. You know, I do want to mention a couple of things. We have to be very careful going into the second half of this year because this volatility that typically comes around can really impact markets significantly. I know some people are being very cautious and just saying, "Hey, you know what? I'm going to be out of this market for a little bit," and I agree. Right now, if you look at your portfolio, you can see that a lot of people are rotating into like yielding assets again. So like CCI is starting to come back a little bit. You know, you have all these REITs that have decent yield. They're starting to come back. So a lot of people are front running the yields right now in anticipation of rate cuts. And some data could come out and throw that completely out of whack, in which case now that thesis can be thrown out the door as well. So we just have to be very, very, very in tune with what's going on in the market and just make sure that
Yeah.
we're positioning ourselves to capture the upside. And I think, right, eventually I might actually even double down on the cruise lines if they get low enough and the RSI dips enough. Because I think right now, especially with Royal Caribbean does not deserve to get beaten up the way that it's getting beaten up right now. So
Well,
I have a
it
price
was
tag
pretty
in mind.
expensive. It was pretty expensive going into earnings.
It was deserved though. That's the way that I interpret it. Like, yeah, but you're right. It is kind of like it is right
Take
now.
that a
It's
hefty
trading.
premium, dude.
But I mean, if you're the best, you deserve.
I mean, for sure. It's like comparing CrowdStrike versus on the one. Like one of them's gonna have more premium. Obviously, the amount of revenue one of them's pulling in is more, and one of them's profitable and stuff. But yeah, if you're the best of breed, which is what they say with software, like you're gonna have a premium.
Yeah. I don't know if it dips low enough. I'm definitely a buyer. I'm.
There you go.
The other one to keep in mind is also Celsius. I think Celsius has gotten to the point where it might be oversold, but I'm not there yet.
Let's chill from selling puts for a little bit on this one.
Yeah, I'm not. I know some people are starting to sell puts on this thing, and I'm like, nah, man, y'all need to dial it back a little. Just wait until it bottoms.
It's the recency bias, right? You see this thing touch almost 100 twice in a row, and then you see it at 50% down. So you think, oh, it can come back there. And it's like, that's not how it works.
Wait for a double bottom, if anything.
Yeah.
Don't wait. Double tops are great, but double bottoms are even better because that means that now you're going to see a rise going forward. So right now, it's not even a double bottom. It's just literally down.
It could be basing out, but yeah, who knows? I think people are waiting for earnings, which is August 8th.
Can we give a little bit of props to ourselves for getting out of this at the height? Like literally at the boo. It was at such a dude. This was the perfect.
It was good. It was good.
Exit.
Yeah,
you could not have gotten better with this one.
But that is it's luck. But the thing was that the second time around, I had a stop in mind, and it didn't get hit. So I just stayed in it, right? But at the same time, it's like, it hit the top. You either sold a shorter call or sold a closer strike call and then bought back the further one. Or what I did was I just converted the shares back into spreads. And then when it got to 100, like I just got out of it completely. I didn't bother getting the shares and everything. But yeah, man, that's some pretty good prospects
when the
come up soon.
When it comes to consumer packaged goods, if the sentiment changes, you gotta be out of it, man. This is not like a reoccurring revenue business. Reoccurring revenue businesses, you could wait until the thing market recovers. When it comes to sentiment, if sentiment starts to go in the opposite direction, you need to be out, man. Nasdaq is down 135.
Yep, it is. It has pulled back. It has pulled back since just like a couple of hours ago, actually. I just noticed that like a minute ago.
How's it compared to the Dow? Oh shit, everything's down.
Yeah, everything is down. Dow kind of lost all of its gain. Russell is up only 1.25%. Yeah, no, it's pulled back a little bit. I mean, I think people are kind of getting a little bit worried that was a dead cat bounce. I mean, it could have been, but all right, that's why we got December 2026 spreads, man.
Yep, that's right. Look at this. Like, share my screen real quick. One of the things I like doing is I like looking at the sectors, and like FinViz does a really good job of that. So you can see here, CRM is up, ServiceNow is up 14%. Jesus Christ.
ServiceNow, man, let's go.
Paycom's been recovering. I don't know if you've been tracking Paycom.
Paycom has been recovering. People got a little bit worried there. I didn't get in it. Are you still holding shares?
A little bit, yeah. Some of the bigger hedge funds, they started to buy into it. So I was curious about that. The regional banks are doing okay today, relatively speaking. But have you ever used this feature where you've gone to like different groups, and then this way you can kind of like see what the performance is like on a group basis?
I haven't looked at it here, but I got to start checking that out more. This is really what hedge funds look at. This is what funds look at. They look at performance, and a lot of them just chase performance, dude. They're just trying to beat that SP 500. That's really it.
Yeah. So like right now, year to date, tech has been the outperformer. Consumer cyclicals have been underperformed. Real estate has underperformed, but now you're starting to see the catch up happen. And so recently, industrials, energy have been leading the pack for the last day. But let's see, 1 month. See, 1 month, real estate is the one that's been doing well. You
Yeah,
see, so
yeah,
it's like the
that's
catch
one
up
that's coming
that's
back.
happening.
I
Yeah.
think XLRE reached an all-time high.
Hmm.
Oh no, it didn't. It reached a 52-week high, but
Yeah.
it broke out of that double top.
Yeah. Half a year is utilities. 3 month performance has been tech, of course, and real estate. I'm telling you, real estate is the one that I wanna look at. And usually this is the good thing. You can actually go into like the different classes. So like this one right here is great. So one of the ones that I'm looking at that's like a favorite of mine is BXP, you know. So definitely
Oh,
worth
there you
looking at.
go. Google new low
Yeah.
a day. It's gonna be almost time to get back in those Google spreads, man.
I think so. I think so, sir.
Damn, 160s. Wow. I didn't think we'd get back here from the 190s.
Ah, man, I'll let it keep going down. I mean, Microsoft is getting sold off. For God's sakes, who is selling Microsoft? But then again, if you
Um,
look at the PE is 36 on Microsoft, and on Google, it's 24.42. I mean, that's actually not that bad. I think Google, relatively speaking, has been about 25 PE for a
yeah,
while. So it's trading at fair market right now.
I know that's the thing about Google is that it has been like one of the cheapest mega caps out of all of them. But at the same time, yeah, that this is historically where it does trade at. So anything further than that, it might actually mean revert. But
Yeah.
I mean, there's obviously that bearish theme about Google where it's like Chat GPT or Chat LLM is going to kill Google search, which I don't think so. I mean, I've used Google search and their Gemini searching capability is actually pretty good.
Yeah. Whatever, man. We'll see where things go. But yeah, I'm glad I'm in regionals and real estate right now.
I
I mean,
should get
outside of
back in
cruise
there, man.
lines. Yeah. I mean, it's the definitely the trade that you want to be in for the next few months until like they start catching up to these mega caps. I think right now, where is this money going? Think of it this way. All these people that are selling Google, where are they putting their money?
Yeah.
They're not putting it in treasuries. They're
The
they're
money's
taking
just
it.
rotating.
Yeah. And that rotation is what, we want to take advantage of. So if you want to find out where the money's rotating, join the Patreon. See,
There you
I
go.
gotta teach you how to get these people into the
Gotta
Patreon,
slide
bro.
it. Gotta slide
You
them
gotta
in here. Gotta slide them in here.
slowly
Yeah.
put it in there. But yeah, I think today was a good first episode. We'll keep
Yeah,
doing
man.
this, and we'll hopefully get a little bit better with the sharing and the technology. And I'm not saying that we'll end up being the next finance junkies, but we'll see what happens.
Yep. Yep. Hopefully get some guests in at some point soon too.
Yep. All right, everyone. Take care. Have a
All
good one.
right, guys. Thank you.
Bye.